Well, here we go with the stocks to buy for, that's right, July 2020. And as things are getting a little bit more intense, right, a little bit more uncertainty out there, there's going to be really a main focus to this one, and that is going to be about sustainability. So these stocks to buy are going to be ones that are focused on portfolio sustainability in the midst of, difficult situations. What kind of stocks could you own that I'm considering looking at least? Some that I already own, some that I'd like to add more on. In uncertain times, what they can do for you. So we will certainly take a look at that and start off here with Bank of America. So Bank of America, you may say financials is definitely an interesting one to look at because of the fact that, in 2008, 2009 financial crisis, these stocks got absolutely obliterated. Now, there is major economic impact, no doubt, by the current issue we're facing, but I will tell you right now, banks were very well poised prior to everything going on, and I think they still be very well poised. They still will be very well poised. And really, my main sentiment for this is really the long-term purchase here. Year to date, this is a stock still down 34%, right? Still 34%. And I think a lot of investors sold this as if it was similar to the financial crisis we saw prior. It's not going to be for these financial companies. It really isn't. So obviously not a good time for them, and that's why the stock's down massively. But in my opinion, the reason it's down so much, that's an opportunity to get in at good prices. Certainly is a time to get in at good prices. If you just look at stock action, that's a good time. Obviously, Bank of America, if you don't know what it is, it's in the name, right? It's a financial company, a bank. Obviously, they have an investment portion of it. They give loans, obviously cards, everything of the sort, not unexpected. So, and again, the issue here is really, I think, everything going on right now. The Fed has made it, they've taken action on financials, which is interesting. So they've pretty much have it to where these are companies that can no longer do stock buybacks, and a lot of these, while they're super low, stock buybacks have been what's really building stock back up. And the fact that they've been completely barred from doing stock buyback means these stocks are going to have weakness for a while. But in the eyes of weakness are where you can find some really good deals. And at a time in which a lot of things are arguably overvalued, you can find some good deals here. And when I mention sustainability, obviously we talk about dividends. This is one that only shows a 4-year growth. But that's entirely because they completely cut their dividend due to the 2009 financial crisis, right? Completely cut it. And it took a while to recover because that wrecked our system like nothing before. The financial system got absolutely devastated. Right now, it's a stock yielding 3.1%, 46% payout ratio only. 5-year growth rate actually now 40%. So they're trying to recover that quite a bit. It's nowhere near where it was, but it certainly, in my opinion, will get there. They're also not going to be able to raise dividends in the next quarter, which I don't think they will anyways. Right now it's about sustainability, and these companies are going to be focused on having cash on hand. So I think there is a potential that they even cut the dividend from where it's at. I don't think they will because the payout ratio is pretty darn low. But it's something that could happen temporarily at least. I think they'll maintain the same dividend, and that's really the same focus of what I'm talking about here. It's sustainability. So for the long term, this is a very sustainable stock, very sustainable dividend, barring any pandemic or crisis type environments. That's going to do well for you. So I think it's a good purchasing rate right now. If you look, a P/E ratio on this bad boy of 9.45. That's right. Pretty cheap. Forward P is a little expensive because of the increased expenses this year, but that doesn't shock me. Overall, I think it's relatively cheap from just a P/E ratio standpoint. And I don't think anyone can argue that. Price to book under 1, pretty cheap. That's all I could really tell you. Nothing really crazy to talk about when you're looking, obviously, at income statement here. Nothing crazy. I mean, it's not a company that you expect to grow revenue on a massive scale, but they have been consistently growing it for a while now, and been relatively stagnant in the last couple of years. And this year, you're likely going to see a down year, really just due to the limitations of what they can send out, as well as loan forbearance, everything like that. People aren't paying interest on their loans, so not a shocker. As far as any expected growth from analysts, this year they're expected a bad EPS number of $1.46 versus $2.75 last year. Not a shocker at all. And next year expected to go ahead and put up a $2.23 number. So there is certainly growth there, but it'll take a little bit to get back to where they were. And it's not a shocker. Our financial system got hit pretty hard because of this, and it doesn't shock me. Revenue is expected to shrink this year 7.1%, but back to growth next year. So could be exciting there. So that's Bank of America for you. Pretty sustainable for the long term, in my opinion. Next up is Coca-Cola. And when you talk about sustainable, you got to talk about this guy, right? You got to talk about him. It's a stock hit hard year to date. I can't lie to you. Year to date, down still 20% in a time in which the Dow is only down 13%. The S&P 500 is only down 7%. Pretty crazy to see Coca-Cola, really a staple, getting hit pretty hard. Still getting hit pretty hard. So if you don't know Coca-Cola, which obviously you do, come on now. We talk about their brands from Coca-Cola, Sprite, Fanta, Dasani, Smartwater, Minute Maid, Innocent, Simply, Georgia Coffee, Costa Coffee, Fuse Tea, Honest Tea, Fairlife, Powerade, CL, Schweppes. You already know them. They got freaking tonic water. It's disgusting. Who drinks tonic water? I would never imagine it. Vitamin water, Gold Peak Tea, Zico, Appletizer, Topo Chico, Aquarius, Addis, Fresca, which tastes like battery acid. But I can't say I don't like it. Aloha's, Ayataka, Barks, the root beers. It's quality stuff. Dogadan and Peace Tea. That's right. So they have foreign brands here, obviously, as you may have noticed. Dogadan being a Turkish brand, and Ayataka being Japanese in nature. So what a shocker. So there's obviously a global brand, but I mean everyone knows just the normal Coca-Cola brand and everything that exists within it. Just pretty crazy. 800 plus drink varieties, right? 200 plus countries offering their products. Over 130 years old company. I mean, come on now. You know Coca-Cola. But again, we talk about dividend on this company, and you just can't talk about dividends without mentioning a true dividend king in Coca-Cola. Currently yielding 3.76%. Payout ratio a little bit under 90, which can be concerning for some. But with that 57 years of dividend growth, it's something they're going to continue. I can't lie to you right now. They're going to continue to grow that. It's by 1 cent a year pretty much, but at this point, that's fine, right? They're still growing the dividend. This year they may increase it by half a cent. Not a shocker if they do, but just quality stuff with this company, if you're talking about for a long-term value perspective, it's one that you can just let sit and earn your money. Let sit and earn your money. You got to love it. So Coca-Cola, if you're looking at it, obviously trading at cheap. All right, I guess I'm done talking. Trading at cheap valuations, P/E ratio of 18 on this company, forward P/E of 22, which not that bad, all things considered, when you talk about pandemic environments, right? Price to book seems a little pricey, for right now, but historically, it falls around that, so it's nothing crazy as far as that's concerned. The PE is what I look at on this company. It's pretty cheap if you're talking about a value stock. Obviously, if you look historically at revenues, nothing absurd here. Pretty well consistent, just consistent company. I mean, they're not going to grow massively. They're not going to shrink massively. It's just because it's a consistent brand. Nothing's going to spark people to start drinking more of their products or, drink less. It just doesn't happen like that. Pandemic or not, it's still going to be a drink company that people consume the products, right? They're still going to consume the products. They're cheap products to drink, where you're talking about water or sparkling water to sodas, to teas. They have it all. These are products that are still going to be consumed regardless. As far as analysts are concerned, expecting this year $1.86 EPS versus $2.11 last year, so definitely a decrease, but completely not unexpected. Not that bad of a decrease, all things considered, with all of these COVID-related costs. Next year expected to go back up to $2.10 EPS, so back to where they were this past year. Nothing crazy there. Expected revenues shrinking 11.3% this year, and next year growing 9.3%. So definitely nothing too crazy there for a company. That 9% growth it'd be closer to just 1 to 5% typically. So to see a 10% growth is obviously a recovery from this past year, or this current year, I should say. So nothing unexpected there. It's gonna lie to me, tell me these pages are unresponsive. Come on now, Google, don't play with me. Next up is the epitome of sustainable, right? The epitome in Walmart. Now, some people may say, what the heck are you doing with Walmart? Well, this is a company, that's right, year to date, barely up. It's flat on the year. Why is this stock flat on the year? I gotta be honest with you. I don't know why it would be flat on the year, because this is a company that has strictly only benefited from everything going on right now. And trust me, as someone who knows the retail industry pretty well, working in it, this is a company that has benefited quite a bit. And this sales growth is still continuing to this day. Still continuing, right? And we talk about fears when, stores were shutting down early, when we were having extra added costs. And yes, you are. But guess what? Despite the shortened hours, despite everything going on, the limiting people inside, this is a company that's seeing sales growth consistently, both in-store and online. In-store and online. And the online growth has only skyrocketed. We're talking about retail sales growth of 70+% online, as far as online sales are concerned. And then naturally you talk about just in-store. I would expect just in-store transactions, they show lower than expected, right? But for a lot of stores, they're still showing consistent growth. And especially with the second wave, this hoard buying might continue, right? You might see another wave of hoard buying. This company seeks to only benefit, right? And when you look at Walmart, there's one thing obviously you want to pinpoint is online, and also this pickup section here. This pickup section's massive, pretty dang massive. Especially with everything going on right now, people that don't want to go in store because they fear for their health are going to use this pickup service, or they're going to use online. And the pickup service is really nice. You just park outside, tell them you're here, and they'll bring your stuff right out to you. It's really convenient, and you can really do whatever products you want on there. Whatever products you want. So definitely pretty exciting. They carry everything. Obviously, it's Walmart. Not a shocker at all. Dividend, you got to keep talking about dividend with this company. 47 years of growth on the dividend. 47 years. Currently yielding 1.8%. Not a massive yielder, but it's a consistent one. 43% payout ratio. Pretty cheap, all things considered, too. That growth just continues to happen. Pretty awesome. That's all I could tell you. You really like to see that growth. You like to see it. So the dividend play is just really good it's a really good dividend play. But I'm also expecting stock appreciation as well with this one. To be flat just seems insane. Trailing PE right now of 22. This seems cheap for the current prices of a lot of these stocks in the market. 22 is pretty cheap. And we're talking average PE ratios over 30 right now for most companies. And for a company that's actually benefited, to only really see a decrease in PE ratio is pretty absurd, in my perspective at least. Maybe I'm wrong. Price to sales 0.6. Come on now. We're getting a little cheap here. I can't lie to you. It's a company, obviously. If you look historically, just look at this. This is cashish. Consistently outgrowing this $500 billion revenue number. I don't know how that's possible. Expected EPS this year of $4.99 versus a year ago $4.93. Expected to grow EPS this year in the middle of an extreme boost in costs, and you know what? They're going to do it. And next year expected $5.43. Holy cow. Massive numbers. It's profitability like you never heard of. Now, the revenue is what needs to shock you. I'll tell you that right now. This year expected 4% growth, and you may think that's 4%. It's kind of minute. Could you tell me what 4% of $500 billion is, right? That is an incredible growth. Incredible growth. You see it with companies like Apple too, posting these massive numbers. When they post anything over really, low single digits, it's massive. Just because that dollar amount, 4%. Are you kidding me? 4% of 500 billion is just a massive number, and I think they're absolutely going to hit that 4% at a minimum. It's crazy to think about it. Next year expected back down to the requisite right around 2%. Not unexpected there. So again, the long term for this is pretty exciting, because think about really just the overall benefit even long term as they get more online customers and continue to keep the same base in stores. Just a lot going on for Walmart. Iron Mountain comes up next. And throwing in Iron Mountain, a lot of people don't know about the stock. Don't know about the company, but it's a pretty good one. So Iron Mountain, I do need to mention, obviously, year to date, talk about hammered. It's in the real estate investment trust category, down 15% on the year. Pretty well hammered. On a business model that's really not affected, in my opinion. So this is a company that's entirely focused on storage of documents, as well as storing, protecting, managing, which protect or managing can include burning. I mean, there's a fact that they definitely eliminate documents too. It's part of it. So this is a company that stores documents for companies, right? Specifically, a lot of big companies, really too. So if that's the case, it's not really a business model that's impacted by this, right? In fact, there's likely more documents than ever right now that need to be stored. I'm just going to be 100% honest with you. We talk about the safety restrictions that have had to happen. Think about how many personnel documents that have had to be filed for really, whether it be tests, screenings that companies have done in store. All this data and really documents need to be stored somewhere, and that's Iron Mountain. Now, really need to mention here, obviously, as I mentioned, data. Data storage is going to be a bigger part of their business. As we talk about just the future of business, we're going to shift from paper to data. Now, obviously, a lot of things are going to stay on paper, and Iron Mountain's great for that too. But data storage is going to be big for Iron Mountain, because, again, data is going to be more important for people to store that as far as, saving any sort of information digitally, and a lot of people are going to need that. So it's a company that's not really impacted. And talk about dividend for this company, right? A whopping 10% yield, 10 years of dividend growth. That's right. Don't look at that 5-year growth rate because it's completely false. Payout ratio is not quite accurate on this one. It's a little bit under 100%, so don't worry about that. Let's see. So this is just a beautiful yielding company that I think will continue to do this, right? It's recently risen the dividend as well. If you look dividend history-wise, look at this beauty. Just look at this beauty. It just consistently pays this lovely dividend. They rose in January, or December, I should say. You got to love to see it. They're going to continue to do it. Not a company that you really need to look at these statistics for, just to be honest with you. P/E ratios aren't really what you look at these real estate investment trusts for. You really don't, because this valuation isn't really how you value it. If you look obviously at income statement, you see revenue has been growing pretty consistently for the company. Nothing really crazy to report on there. And analyst-wise, well, EPS, if you want to mention it, it's not super important with these companies for the most part, but EPS this year of 85 cents expected versus a year ago $1.02. Not crazy there. I mean, you expect pretty much every company is going to see a decrease in EPS this year. Now, next year expected $1.17 which is, again, growth. If we're talking about, 2 years over, still growth. So good stuff there. Revenue estimates down, expected to decrease 5.8% this year, and then next year increase 5.8%. So it's not a rapid growth company. It's just a consistent company that I think is going to be a consistent dividend payer as well for you. And that's why I'm a big fan of it at these levels. I think the stock deserves to be over $30 a share. So I think at these levels it's still pretty cheap. So those are your stocks to buy for July. Hope you enjoyed.